Let's dive back into these markets and this early morning sell-off here with Michael Lee of Lee Strategy. Good morning, Michael. So why the aggressive selling? I mean, it can't all be what Fed Chair Powell said yesterday. It's no great surprise here that the economic recovery is going to take some time.
Yeah, look, I just think that, how much is the NASDAQ down right now? We're down 2%. We're still up 24% for the year, 23% for the year. So, I was just mentioning to Brian the last time we were on, maybe there's going to be a rotation out of tech. I still think a lot of these names are winners over the long run, but you're getting a little frothy there. We have had exceptional markets. We're up 3% year to date, considering the economic carnage we've gone through. That's nothing short of remarkable. What you're also hearing about in the background is the Fed has slowed their corporate bond buying program. I think that, if this sell-off were to increase and accelerate, I think that would show up again if credit spreads were to widen. I'm not worried. I think the buried lead in today's employment number was continuing claims, dropping by almost 1 million jobs. As you've said, you've had over 60 million people file initial claims. What I'm focused on closely, and what I think is the best real-time gauge of employment, is those continuing claims numbers. A lot of these state unemployment offices are overwhelmed and inundated, and I think with opening, closing, opening, all these sorts of things that's going on there. Companies that thought they can hang on, they can't hang on, letting people go. There's just a lot of noise and a lot of the data with some wild revisions. But this continuing claims down to roughly 12.5 million. We were 1.8 million pre-crisis, so we got about 10 million jobs to get back to that level. We'll see how quickly we get there, but we are in a substantial V-shaped recovery. Retail sales number that came out yesterday was pretty good. We're up 2.6% year over year. Retail sales hitting an all-time high, even with 12.5 million continuing claims and everything that's going on. I don't know if we're going to see additional government stimulus. I don't know that we necessarily need it as the economy as a whole. I definitely think those people in the bottom of the income stratosphere desperately need it. So we'll see if Congress can come together with something. If we don't get it, I think we're in a new business cycle. We're in a new bull market, and these pullbacks are your opportunities to get involved. If you're sitting on the sidelines, or you own some real high quality winners in the fixed income market, and you want to rotate into some equities.
Michael, what's your best advice to the investor waking up this morning and seeing that Snowflake rose over 100% in its first day of trading, and right now they're getting ready to plow their entire life savings into Snowflake? But before they hit that button, give them your best advice.
Yeah, don't do it. That's, look, there's a difference between investing and speculating. And so if you want to get involved in a technology name, I'm much more inclined to say buy some Apple. They're going into the 5G super cycle. And you look at the services business. The services business for Apple is expected to generate 50 billion in profits by 2025. That in itself is $1 trillion company. And you could see with the bundled services package that came out on their investor day the other day, there's just a lot better places to put your money in. Those for the risk adverse. There are names out there like ExxonMobil and AT&T that have not cut their dividend. I believe that those companies would have cut their dividends if that was in the plans. I think asset divestiture is much more likely for AT&T to meet cash flow needs than dividend cuts, and same thing with ExxonMobil. So I think you can kind of barbell yourself with some growth names and some kind of tried and true American staples where you can collect some dividend. And at some point, those are going to come into favor because given the deficit situation, given the debt situation in the U.S., the next step for the Fed is yield curve control. I don't think rates are going up in our lifetime. I don't know that we've completely Japanified our entire country, but a lot of these high dividend names that are out there where those dividends are particularly safe, those are going to come in. Those are going to go from 5 or 6% to 2 or 3% over time. So you're going to get paid to wait for those to come into fruition, and you can sleep at night knowing that at least the cash flow is safe for you.
So I hear you on the dividend paying stocks, always looking attractive, especially during a pandemic and all the uncertainty. But are you a seller of tech across the board right now? Are you cherry picking? What are you holding on to in that sector?
So for tech, it depends. It depends where you got involved, right? So what I think a lot of investors are looking at, and I think a lot of the sector that's going on right now, is that tech has done so well. It's become such an overweight, and similar to the holder in Tesla, once tech becomes too much of your portfolio, you just have to trim it from a risk management standpoint. So, if you're just starting to get involved with it and you're legging in now, this is a great time. Like these Apples, these Amazons, the Googles, they're going to face some regulatory pressure, but they're not going away. And in reality, if you were to break some of these companies up, I think you'd unlock a lot of shareholder value. I think once companies get to a certain point, you stymie innovation, they move slower. So if anything, over the long run, those, the breaking up of those companies would probably be a bullish for the shareholder in the long run. But that's the only headwind for those companies other than valuation. So I'd be a dip buyer in the tech. And then on the other side of it, you could start like a consumer discretionary. I like that sector. And then the other sector I'm looking at is the biotech sector. So there's an ETF XBI. And so that stock, that sector had really not participated in the rally from 2016 up until, pre-pandemic, and has kind of come back a little bit in the pandemic from the famous Hillary Clinton drug price control tweet. Well, that sector is starting to break out now, and that those things tend to move for years. There's a lot of consolidation in that industry, and I'd be looking for the home runs in that industry versus tech. And then in terms of the IPOs, if you can't get an allocation from your brokerage account, it's really hard to get involved in a hot IPO. And speaking to people that run trading at some of the largest hedge funds in the world, nobody is ever happy with their IPO allocation, especially if it's going to be a good deal, because that's essentially free money. So what I'd look for in some of these deals, like a Facebook, it came public, I think 38, traded up to 43 or 44, and then went back down to 19. So if this snowflake gives off a lot of those first day gains, then you'd want to get involved. I mean, you have Warren Buffett involved in there too, Salesforce. It looks like this company is going places, but when it trades up to such an astronomical valuation on the first day, that's just not something you want to chase unless you want to lose money.
All right, we're going to leave it there. Michael Lee of Michael Lee Strategy. Always good to see you. And right now we've got that tech heavy NASDAQ down about 200 points, the Dow off about 300.